Today we're going to be talking about creating certainty in your trading process. Stay tuned, traders. We'll be right back. Good day, traders. I'm Stacey Burke from Stacey Burke Trading. It's Wednesday. We have had two stellar days of market conditions on the pound crosses as well as gold. Obviously, pound USD, pound Aussie, and gold and the euro yesterday all had big days. A couple of textbook setups on the pound crosses. Gold just trended the entire day, first day of the month. Lots of huge moves. A lot of traders picking up a lot of pips in either the US or London session, and some in the Asian session as well. Today we're going to review simple concept. We're going to talk about a couple of other things related to demo or small account trading versus real live size trading, and the difference in how the brain perceives information, the difference of behavior in live time, and some of the tips and tricks traders can maybe access to helping improve not only their perception of what's really going on in the markets and working on mindfulness, present state consciousness, but also being aware that the illusion of the market being trading one system or system jumping to other things, the illusion being that that will be better, when the reality of it is emotional versus rational brain thinking in terms of live small or demo trading versus real size and real market conditions in live time. So today, talking about creating certainty in our trading process, and again, I've talked about this over and over again. I harp on the fact that traders talk about back testing and they want to do different types of strategies and try this and try that, but the reality of it is, when it comes down to live performance trading and you're putting capital into the markets, you're trading in an uncertain environment. The outcome is uncertain regardless of your system, regardless of your approach. And the reason why I've stripped things down to a very straightforward cookie cutter approach is because, number one, all of those factors will be the same every single session. We're going to have a high, a low, we're going to have timings, very specific timing window, we're going to have round numbers, we're going to have engulfments and pin hammers if a trade opportunity presents. And as we know, every single session pretty much there is an opportunity, because the smart money need to move the markets in order to make money, whether that's to continue a move as we saw in gold yesterday. And even on a huge trending day like gold, they still had a counter trend stop hunt. And when was that? In the equities hour, dragging traders in the wrong direction before continuing that move for another 100 pips. So again, reviewing, I've mainly only been trading gold. I keep saying this, it moves, and a lot of traders have been concerned about the volatility and whatnot. And my response to that is that volatility is the same, it's position sizing that changes in terms of adjusting to the volatility. If the ATR of a 15-minute bar is bigger, regardless if it's the pound Aussie, could be the euro, it doesn't matter what it is. You adjust that according to your risk that you're prepared to take on that trade setup. So you don't risk a constant amount on every single trade. If the volatility is different, I adjust my sizing down, but I also base that on the setup and what my perception is of the asymmetrical risk reward on that particular setup. So again, high of day, low of day. If you're not sure where they are, if the market is still evolving, okay, we had an example on the pound yesterday. We'll review that, some questions about the pound, and we're going to go over some very straightforward examples, but also understanding the timing window and how you're processing that information in live time, because the market is going to give you boundaries. It's going to give you traps. We talk about that first hour: stop, hunt, trap, stop, hunt, trap, stop, hunt, trap, unless we're in a trend market, which in many cases can be a continuation of that move. But there's always a stop hunt back into the trend before they continue it. And that comes back to how you're processing that information off your chart, what it is you're looking for. And again, the timing window, 8 to 11 p.m. for Asia, 2 to 5 a.m. Europe, London, 8 to 11 a.m. for New York. That's New York Eastern Standard Time. Again, just Google wherever you're at. Look at your chart, whatever candle time it is. Google New York, figure out what your timing is based on your charts, and go from there. You can trade outside of those times, but I think as more and more people are emailing me, they're finding out that when you trade in these times, it's 50-50. And again, I've talked about trying to filter out. I don't want to be in the 50-50 game. I want to be in the 90-10 game, because 50-50 is exactly that, 50-50. And over the long term, you better have a very good in terms of your risk reward, you better be carving out 3, 4, 5 R on your trades if you're getting 50-50. Round numbers, double zeros. Again, double zeros and 50s can act as the boundaries for our 50 pip boxes. Yesterday we saw over 300 pips on gold, so obviously they were moving it in 100 pip increments. On some of the other pairs, usually on the pound Aussie, we'll get 50 pip increments if they have a big trending day. Yesterday's a classic example. Day 2, level 2. Trending markets, pound, euro, are trending markets. First day of the month continued that for a measured move. We may see a day 2 opportunity on those markets again today. But engulfments and pin hammers. The engulfment is where the market locks in the high or the low. The pin hammer will be the confirmation of that trade, unless we're at a blow off into that equities hour after 2 hours of movement, and we get a 3-bar reversal. We can get, and that's usually at the high or low of the week. We can get a pin hammer on an extended stop hunt after 1 hour of rise. So again, 1, 2, 3, 4 pin hammer at the high, not inside the high, at the high. And there's a big difference. So again, we'll review that on the charts. But this is about what I've done to create certainty in my process right down to the minute. I'm going bar by bar. I've talked about this before. Focusing on 12 candles. Understanding, in the majority of cases, unless we are inside a peak formation, we are going to see a trap and a stop hunt. The whole purpose of that is to take traders in the wrong direction or to get them in early. Hit the stops again, lock it in, and reverse the market. If it's a trend trade, if you don't see a reversal or a stop hunt into the trend and that market's moving strongly, don't counter trend the peak formation. So if the market puts in a peak and it keeps falling and doesn't come back, why are you trying to go long against a down market? Wait until we get that confirmation either on a double bottom. Okay, the 33, we've had people ask, what's a 33? The 3 pushes culminating on a 1, 2, 3 in the last leg. You can't do anything until you have a high or a low in place, unless it's a blow off inside of a trend. So they move it up and they come down vertical into an existing trend. Those markets can reverse on a V bottom. But if you're at the high or at the low, we need to lock in a high, put a high in place, and then work back into it. We're getting traders chasing the move back past the peak formation for a measured move. They get caught, they get locked in, and the market reverses. And usually that last burst to the high or to the low will end on a 1, 2, 3. 3 candles, 45 minutes, sometimes 4 with an inside bar or something that ends at or near the high or the low. So, emotional versus rational brain. If you haven't listened to any of the work by Randy Howell, I recommend you go and do that. He's a clinical psychologist, I believe, but he has tons of material on YouTube. Randy Howell. He talks about natural selection. And natural selection is when he talks about traders getting mad about losing, getting frustrated about their system, getting angry, and he says plain and simple, it's natural selection. You either evolve because your brain is emotional. It's designed to help you survive. And if you can't evolve that to be able to do that in live time, because when you put capital on the line, but it's at size and you're in fight flight, and many traders know about this, especially if you've blown up trading accounts. As he says, you go down the vortex and you absolutely lose the ability to rationally focus unless you have a process to keep bringing you back into mindfulness and present time consciousness, to be able to process that information, but also not to self-sabotage and do damage. Average into losing trades. Take trades that aren't even in your trading plan. Get in too early because you're so excited to get into a trade and make some money. Professional traders have the ability to perform in live circumstances consistently. And they've probably developed that over small incremental improvements. And most of them have blown up trading accounts. But you have to rewire your thinking and figure out where it is that you are most vulnerable to making mistakes. The market's going to do the same things over and over again. It needs to trap traders in order to make money, the smart money. The market is the smart money, the big money, the institutions, the banks, hedge funds, central banks, whoever they are. It's us and them. And as I said the other day, if you're not making money, you're losing it unless you're completely neutral all the time, which means that if you're trading all the time and making no money, you're not getting paid for all that time and effort. So just to revisit some concepts, the market does not care how hard you work. It has nothing to do with hard work. Everybody works hard. It has nothing to do with what school you went to, how smart you think you are. It has nothing to do with, in many cases, the system. It's about your ability to perform in live time if you have an edge, executing that edge, and then growing that consistently with size. So if you can't get that consistency, figure it out what it is. If you're getting in early, draw a line and say, I'm not doing anything until it hits that level. Not here. If the market does this, that is not the high. That's the high. Up here, we want to see a pin through the high. And if they do put a pin and it's a 1, 2, 3, we want to see them engulf and then go back 1, 2, 3 and give us our M structure. As I said, the only time you're going to end a market on 2 candles, a 2-bar reversal, is when they have gone through. You'll get 3 bars, a pin, a reversal candle, or a final bull push, and you'll get a candle that will come inside. It's a 3-bar reversal, okay? But again, that's 45 minutes. And that's after they've hit the stops. That's a peak formation. Print off your charts, study the highs and lows, and then make sure where we're at in our template. Are we inside of the high and low of the week? Are we outside? If we're outside, markets end on pushes. They might blow off, but they'll lock in a high, then they'll have a second grab at the cash, which is usually going to be a small bull hammer at the high, maybe. It could be a reverse bear pin at the high. It can be any one of those, but it will usually culminate in at least 3 candles if it is not an M or W formation. And again, there are the exceptions. If we are stop hunting back into an existing trend is up and they stop hunt down, we can get a 2-bar reversal. That can be the low of the day. But that will be in a strong market. And that's important again to understand the timing window, because that will usually occur at a 1, 2, 3. And if they put a peak formation in, they'll come back into it a second time, even if they don't take out the low. We call that the shortened W, shortened M, as opposed to an extended M or an extended W. So we had the type 1, type 2, type 3. We've talked about those before. Create certainty, but all of those will usually occur in that 12 candle window. The exception being, as we've talked about, the 3-hour formation that can occur just outside of our 12 candle window. So they build it up over 3 hours, okay? And often that happens in the US session. And then into that later hour, or into the close, they'll put another peak formation in before they finally move the market. So they jam them in. We saw this last week on gold. They hit the high, they pulled it back, they hit it again a second time, pulled it back, they hit it a third time, put a pin up, dropped it down, went sideways for an hour before finally rolling it over later in the US session. Print off your charts, study the highs and lows, look what time it is, go back step by step through your own process. When you're preparing, how are you marking your levels? Do you have a peak formation already in place? Do you have a thesis? If this, then that. If that doesn't happen, what is your opposite perception? As I said, I'm mainly trading gold. The gold market moves every session. Without a hitch, it moves every session. So there's going to be 50 pips today. There's already been 50 pips in gold this morning. So you're not going to get every single trade. Don't worry about that. Figure out if you're improving each and every trade, not only with your process, but in your live execution and processing of that data. That's the difference between emotional and rational brain. That's the difference between being able to increase in size because you've hardwired your nervous system, not about reading it all and figuring out is it up or down, or should I go long or short, but having a process, step by step, going through bar by bar, recognizing that there's going to be that behavior that the smart money has. If nothing happens that first hour, guess what's going to probably happen in the second hour? There's probably going to be a burst, a stop hunt to the high or to the low. Until they get there, as I said the other day, I'm not even interested unless that market is in a blow off heading into that equities hour. So let's review the charts from yesterday. Again, figure out where your process needs to be tweaked, where you're not processing things. If you are, one trader sent me a screenshot yesterday. He nailed the pound in London, crushed it, and just straightforward. He saw the second leg, 1, 2, 3 engulfment. He locked it in, and then another trader tells me they see the 33 heading into the US. Creeping trend after a 50 pip move, pin hammer at the open of the 12 candle window, breakout pullback 50 pips plus all the way back up to the high of London. Remember, who's in the money? If somebody shorts it in London and they're working it into the low after 50 pips, guess what's probably going to happen in New York? That's a 33. One push, two push, 1, 2, 3, boom, straight back to the high, through the high of the day for 75 pips. So stay disciplined, stay focused, do the work, create certainty in your process in an uncertain environment. And as Randy Howell says, it's a process of natural selection. You either evolve or you get killed off. Stay disciplined, traders, stay focused, and may the markets go with you. Have a great trading session.
Good day, traders. Stacey Burke from Stacey Burke Trading, just continuing our discussion on creating certainty in an uncertain environment with your trading process. Yesterday on the pound, we saw the market trading inside of the previous day's range. The market moved up right off the beginning of the day, engulfing and moving sideways and then continuing through Asia as we headed in towards our 12 candle window. So at this stage, the market is obviously in a small micro trend. We get a small bull hammer at the last candle prior to our 12 candle window. And you'll notice the market broke through the high of the Asian range and extended that out. We see a little rectangular structure at the high. The market continues that for a stop hunt through the previous day's high. So again, coming back to looking where the money is, the market went up, hit stops, and moved sideways on top of the last swing high from the U.S. session close. Broke up towards the previous day's high, triggering breakout orders, take profit orders possibly, hitting stops, stop losses on traders that may have been short in the U.S. session that had not taken any money off. But we have our first hour. And again, the thesis in that first hour is stop, hunt, trap, and then trade, hopefully. So we see our first candle, and again, going candle by candle, we'll blow this up. If we just zoom in, stretch this apart, we've hit the previous day's high. We have a bear pin hammer. We have no engulfment. And again, remembering the narrative, understanding that We want them to lock in a high or a low. The pin can be a stop hunt. The pin can be the high or the low. And in some cases, we will often see the extreme now being in place. But we also have that market pinning up through round numbers. We're at double zeros. The pin to the high is the first candle of the equities hour. What that is now established is a high and a low for the London hour. That market is still making new highs. Yes, that may be a stop hunt, but at this stage, all we have is a market breaking through the previous day's high and pinning higher. The market then on the next candle pins below that whole entire range. Now, think what this market could be doing. We have a pin hammer. Traders want to short pins. They short that pin. Guess who's in the market now? Breakout traders who see the pin hammer. They're shorting this market down here, and their stop most likely will be at the high of that pin. That's called the pin bar strategy. But this is the first bar of our equities hour. This is now our high and low for the London Open. The market pins the low and comes up 1, 2, 3 candles. Higher highs, higher lows, regardless if this is a bull candle, bear candle, doesn't matter. They come back 1, 2, 3 to the round numbers underneath the pin high. This puts heat on all the traders who are short on this pin bar, whether they got in at the close, whether they got in at the break, whatever that may be. And then we get our engulfment. But not only do we get a break of the small bar, so when people ask me, where do I get in? Where do I get in? How about trading the break of the small bar? Because when that bar breaks, we now have a market moving down. If you don't want to trade the break of the bear candle, you can get in at round numbers. You can get in at the close of this candle. You can get in anywhere in this 3-bar reversal. It's a 1-bar stop at the high of the day. So this is important to understand because this is going to happen over and over again. They're going to get you in early. There is no trade confirmation for me in this area yet. I see this all the time and I lick my lips. When I see that pin, I'm looking, where are the numbers? Before this even starts, here's my 50 pip box. Okay, we want them to go to the blue tracer, but what do we want to see? We want to see them go up and lock it in. They've pinned through now, so there's my first signal. They've put a pin up through the high. This is a classic identification that they may have just cleared out stops, but we still don't have a trade set up. They go up 1, 2, 3 and engulf it. So again, I'd be looking, this is the example I talked about, 3 bars on a 15-minute chart. Smaller time frames. You may be able to time that better or just get in at numbers. Once you've got this 3-bar structure, you can do whatever you want. They gave you another bar still to get in. They come back down for a 50 pip move back down to the low of the day. They pin through the low of the day, but they come down in 1 push, 2 pushes, and 1, 2, 3 into the US 12 candle window. We have a middle structure. So again, 3 pushes down. We have a middle structure now, right? If you want a W, you need a middle structure. If you want an M, you need a middle structure. So we wait. We have that. We've got a bullpen hammer. I'd be in the market anywhere in here. If they break out and I've missed that, I'd be getting in back in here. It's still a 1-bar stop. They've pinned through 1, 2, 3. The first trader, the first mouse, still gets a bit of heat. They go to break even, they get stopped out. Again, we've got a W. When do we expect this? At the low of the day. 1, 2, 3 down. This is the same thing as an engulfment. When this market starts to break through, you can get in at numbers. You can trade the break of this pin. After the 1, 2, 3, you can trade the break of the pin bar. This is a stop hunt into the existing long trade. So again, understanding the counting of the candles. We had an engulfment before the middle structure. Down here, little inside bar. We get our middle structure. That's the last grab coming down. They pin up into traders that are short on this last leg. They engulf the little inside bar. We get our pin hammer. The market breaks through. We get a 1, 2, 3 reversal. Again, 3 entries. You can trade the break of the pin. You can get in at the numbers. You can trade the break of the bull candle. The market still gave you 50 pips. Our first target is the high of the previous session, which also happens to be the high of the day. So again, we had 1 push down, 2 pushes down, and a 3rd push down into the low at the last grab of the cash. That gave us our middle structure, and the 50 pip move back up. Timing window, 1, 2, 3, 4 candles in our first hour. Then the equities hour became the 1, 2, 3, back down into the traders who were long. Continuation move at the end of the equities hour for the move back through the high of the day. Pay attention to the timing window. Don't get caught chasing price action. Understand when the high is locked in, when the low is locked in. They lock it in. We get a second grab at the cash. There's our pin hammer after the engulfment and the trap. They break out. They stop hunt back into the breakout trade, and then boom, explosive move through the high of the day. Looking at the pound Aussie, we have our high of the day taken out in the Asian 12 candle window. We have our low of the day as we head into our Asian 12 candle window. The market engulfs 1, 2, 3 engulfment pin hammer right at the open of the Asian session for a move to the high of the day. So again, just pointing out some obvious things to start to recognize. They have locked in the low bear. There's our low of the day heading into the session. Now they've engulfed and come back down. They creep it down. 1 push, 2 push, 3 pushes, go sideways. We get our little 2-bar engulfment explosion before the 12 candle window. They break through the previous day's high. And remember, ask yourself, where's the money? Well, we know the money's at the previous day's highs and lows. We also know it's at session highs and lows. We know there are stops on traders that are short at the high of the day. They go up and they hit those stops and they keep going. First hour, they've hit the previous day's high. They continue that in the equities hour. They move higher. Last candle of the equities hour defines our first hour of trading in London. The market pins up through there one last time. So 2 hours plus going up. They engulf it. That is the difference. They extended the move out in the equities hour. A 3-bar reversal at the high at round numbers. The market then moves sideways underneath before dropping down to the low of the day. So an example of where traders are in the right trade. But the market consolidates underneath before continuing the move down. And again, counting the pushes. 1 push down. 2 pushes down. And then a 1, 2, 3. Culminating into the open of our US 12 candle window. We get our middle structure. Okay, so again, 1 push, 2 pushes. 1, 2, 3. 33, reversal, first hour. We get this little candle after the middle structure is printed as our entry. You can get in here. You can get in at the numbers. You can wait till the equities hour prints. You can get in on the bull candle. They come up. There's no stop on until we get into near the end of the equities hour. The little bull candle at the end of the equities hour is an entry opportunity. So again, the market's already in trend. We're just 1 push. 2 pushes against the trend. The market breaks again before blowing off. So again, 3 opportunities to enter this market. Ideally, we're entering in the market at the low of the day after the stop hunt through the low of the day. So again, 1 push, 2 push, pin through the low. They come down, but they don't get to the low. 1, 2, 3, middle structure, pin hammer at the open of the session without going to the low. But again, they've already gone through there and done their work. How should this trade behave? It should explode on the next candle. Does it? Yes, it does. It breaks through the high. This is a possible opportunity when this first candle of the equities hour prints, when it's a bull candle, to possibly go to break even. They've layered on top of the middle structure. There may not be a 1, 2, 3 as we saw in the pound. So Again, you've got a 1 bar stop at the low of the day. Where's our first target? The high of the day. We have middle structures all the way up here. As soon as it clears these lower highs that are built into this leg, which would be on shorter time frames, this market is on its way. Every time there's a pin inside and they break that pin, those are trap traders. These are all things that you should be able to start to recognize, but most importantly, understand that equities hour, that high and low of the London hour or the New York hour, if it's not already inside of a peak formation, that is going to be the high or the low of the session. They may go back and pin it as they did at the first candle, but that high and low of that London hour were in place, and that's very important to understand. When we look at gold, gold was an all-in, always in long day. Right from the start, again, we saw this right setting up possibly right from the beginning because that market layered on top of that U.S. session. So again, when we see that market, again, we talked about this the other day, the possibility that this was a day zero type day. Day zero, again, just reinforcing that market that level 3 trades on both sides, back and forth, back and forth. It moved away in the U.S. session and then layered on top. One push down. So again, we're drawing creeping trend down on top of a layer. Expect an explosive move. Lower highs. We get 1 push, 2 push. The market reverses off the low. We expect a third push. That's it. The 1, 2, 3. That's the third push. No follow through. The market breaks up with a bullpen hammer, engulfs the opening bar of the day. They layer on top of that. So 1 push, 2 push, no follow through on a third leg. Breaks out, pulls back, breaks out again, pulls back, keeps breaking higher. They break out of that smaller geometrical structure. We can put our measuring tool on there. The market keeps layering on top. Breakout, pullback, continuation. Okay, this is not a stop hunt. A stop hunt breaks out, pulls back. Breakout, pullback, continuation. It keeps breaking through the highs. We head into our 12 candle window. We have an engulfment continuation right at the open. 1, 2, 3 that goes for a measured move. This market just continued to go all day long. And again, just looking at our measuring tool, 3 full expansions where we culminated in a peak formation before we even saw a real stop hunt. There was a stop hunt just prior to the U.S. session 12 candle window. We'll get rid of this. So again, an example of understanding when you're in a strong move, how to draw your levels. We got double zeros. They pin off of there. Pull back, bull candle. We draw a line at the low of the bull candle. They work it down, inside bar. They break out of the inside bar into the open of the U.S. session. They break through the high, three candles. You'll notice the 3 pins again, but no trade. No trade in this candle formation. They break higher. They take out the high of the day before engulfing the peak formation. And again, that's in our equities hour, second candle equities hour. A second candle engulfment in the equities hour is an open test rejection. The market goes sideways before dropping down 50 pips. Now again, this is a trade that traders, you're counter trending a majorly strong day. I'm not necessarily overly keen on an all-in day on counter trending them, but this was still a good trade setup, but an example of where you can fight for a better fill price, but also understanding when they did pull back and then went 1, 2, 3, if you were in this trade and you had not taken your 50 pips, or if you were up 50, this market has moved 100 pips. You need to be covering, being at break even, because in a market like this, more than likely it's going to continue as it did. 1 push, 2 push, 3 pushes before pulling back into consolidation. So again, opportunities even in strongly trending markets, but waiting for the market to lock in the high or the low, and understanding the importance of that equities hour and waiting for them to make their move, not anticipating what they're going to do. Don't get fooled by the price action. Traders shorting this in here. There's no trade in here. 3 pins, but there's no trade. And then boom, they blow through another 50 pips before putting the doji pin in place on the first candle of the equities hour and engulfing it, making you chase the fill. Again, the fill and the gap are totally separate there. Some traders may have got in at double zeros. Obviously, on a large candle day, when there's volatility, as I mentioned, if you're trading this and you're concerned about the size, either don't trade it or adjust your position size or get in on a better fill. Fight for a better price on a shorter time frame once the trade has been confirmed. These are all things that need to be developed and tested and honed in live time, but being prepared for that through your process, your execution, and your ability to process that information in live time in the midst of the heat of the battle. So hopefully you got some value from today's video, traders. Create certainty in your process, not only for your tactics, but your emotional orientation to be able to execute and trust yourself and do the right thing and process the information and have mindfulness and awareness when you're live at the screen. Have a great trading session, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.